And so the time has come that we need to add a little bit more complexity to our transactions. And the reason, quite simply, is that we don't live in a world without tax. So we're going to have to learn how to deal with sales taxes. But also, we don't get nice textbook statements about the transaction. We have to use actual source documentation to figure out what happened from various departments. So before we talk about sales taxes, which is by far the most complicated of the topics today, we'll just do a little bit, sort of an intro on what source documents are, because our first practice is going to have us do transactions from actual documents, which takes a bit more time to do each transaction. So let's just do a little life cycle here of source docs. So here's some source docs. And that's what we're going to talk about just for a sec. And of course, this relates to generally accepted accounting principles, some of your gaps, two of them, right? The cost principle, that all transactions are recorded at cost. And of course, that's closely tied with the objectivity principle because which says that you have to have objective evidence to do accounting. You've got to have some factual based piece of evidence, and that often is a source document. Right? And the reason for that is because rather than guessing or using your judgment about the value you should record a transaction at, it needs to be objective so that 5 different accountants would come up with the same value. And that is the case when you're, of course, looking at a receipt with a number on it. So that's the whole idea. So one of the first things, just imagine a somewhat large organization, all these different documents, and it would start with maybe a purchase order. You need stuff, your purchasing department fills out a purchase order. And these are divided into different departments, often in large organizations, mainly to have some oversight and to prevent fraud. Because if you can control all these documents, you can make up fake purchases and steal money and that sort of thing, right? And that purchase department will go somewhere to be approved. And at some point, when it's approved, the order is placed, and a purchase invoice sometimes is made. And there's no rule about set rule about how all of this works. Every company is a bit different, but generally this internal document, a purchase invoice, eventually finds its way into the accounting department. And when the goods actually arrive, they come often with, that's a C, a packing slip. And that's to verify that what was actually, that's a K, good grief, to verify that what was actually ordered was received. So that's either matched up with the purchase order or the purchase invoice, to make sure that before payment is authorized, the receiving department verifies what was actually shipped. So the company that sent it sends the packing slip, and the receiving department should check the packing slip and the actual items to make sure that they match. Then, often at the same time, you'll get what's known as a sales invoice. And that's some of the confusion comes from that. So the sales invoice is actually, let's just say it's theirs. In other words, it's the company we bought stuff from. So it's not our sale. It's actually a bill to us. So this sales invoice comes and eventually also makes its way to the accounting department. And once they verify that what was ordered was received and they get the bill, then they'll send out an authorized payment. Right? So a check or a check copy, right? All of those things, well, not all of them. So the sales invoice results in a bill. When it's paid, that results in a payment. So a payment's on accounts receivable. And the purchase invoice is what's used for the actual cost or expense or the purchase of an asset, as the case may be. And there are others. Don't forget, this company can also send a sales invoice to its customers. So this sales invoice would be ours as opposed to someone else's. And the identifying factors, which I'll remind you when I actually show you one, is whose name's at the top. But there's other sort of source documents too, right? There can be memos. So there can be memos from the owner or contracts, like mortgage contracts. There can also be bank statements. Those are used a lot because often the bank, when it takes interest off for, say for debt, it doesn't send you a document. It just tells you right on your statement. Or bank charges like bank fees, monthly fees. Those all come on the statement, and the bank just assumes that that's enough for you to do your record keeping. Like you won't know about it till you get the statement. So a bank statement or a verification of a bank deposit, sort of a bank receipt, and then on the sales side, I didn't spell that right, receipt. There's also things like cash sales slip or cash sales summary, that if you are a business that sells stuff for cash, that at the end of the day you sort of have to keep track, and often this is printed out by your cash register or whatever. It tells you what your cash sales were so that you know, because there won't be an electronic version until you go to the bank and make that deposit and get a receipt for depositing it, which should then eventually one day in a month when you get your statement, it should show up on the statement. So that there are a lot of different documents. The main story, though, is this one sort of all in the center here, right? So let's look at a couple then. Here's an example of what would just be called sometimes an invoice or a sales invoice. And whether it's ours to a customer or whether it's a bill for us, that it was a sale to someone else, it depends on whose name's first, right here. So the company that made the invoice puts its name at the top. So if our name was at the top, this would be a sales invoice of ours. It would represent revenue. So it'd be a revenue journal entry that you would have to record. Likewise, this purchase order would not necessarily be a transaction at all, unless it was matched with verification that the goods were received or that a transaction needs to be recorded, right? Just the mere fact you've ordered it or that this order's been approved does not necessarily result in a transaction. And then here's an example of a packing slip. So if you look at this purchase order, they ordered 15 of these. There's the value. And then you have to match that with the packing slip. And you'd see that actually instead of 15, only 13 arrived. So when you eventually got the invoice, and it may have come at the same time as the packing slip, you have to make sure that you were billed for 13 and not the 15 that you ordered. So they all sort of look the same. The key to remember is a couple of things. One, and they all have identifying numbers and the date that they were made, right? But the real key is remember, whoever its name is first, that's who it's from, and that'll determine whose invoice or bill it is. So is it whose cost and whose revenue is it? Well, that's largely impacted by whose name is first. And don't forget, they'll all have sales tax numbers on them too. So you're going to have to start to look for that. So let's move on to sales taxes. Sales taxes add a whole new level of complexity to accounting, well, to journal entries. So if you found the course difficult up to this point in time, I would strongly suggest you get some extra help, do some more practice, because it's about to get a lot more complicated with sales taxes, discounts piled on top, and then a whole bunch of adjustments once we get to that step of the accounting cycle that we've never done yet. So without further ado, let's talk about sales taxes. So you probably all know that we don't live in a world without tax. When we buy stuff, we have sales taxes. And in this particular part of the world, I'm talking about the HST, the harmonized sales tax, right? These taxes affect the transactions that businesses have. So we have to learn how to record transactions that involve these retail sales taxes. So there are two kinds in this province. One, there's provincial and there's also federal. They were combined into the harmonized sales tax of 13%. But there were, just so you know, there's 8% for provincial and 5% that goes to the federal government in Ottawa. So, but now, it has been for a while now, we have a single tax to worry about when we do journal entries, the harmonized sales tax. So how does this work? If you kind of understand the concept, it makes dealing with some of the accounts a little bit easier, I think. So if you envision this as a business, and let's say somebody goes and buys stuff from this business, right? And that amount was $100. Then what this person is going to pay to this business is going to be $113. And it's how we deal with this total amount that matters. That's what we're learning how to do. So let's imagine that our business, this breaks down, right, into the original ticket price. And that's important because this ticket price is what the business charged, which means this flashing ticket price is the business's revenue. The rest is just complications. And it's complicated because this customer paid $113 to the business. So the business is holding the whole $113, but only $100 of it belongs to the business, right? The other $13 is the tax, the sales tax that the business collected on behalf of the government by law. Which means, of course, it's not going to stay with the business. So if this is our business owner, this $100 is the business's revenue. And this 13, well, 8 of it goes to Queen's Park in Toronto, right? The government of Ontario. And then the rest goes to the government of Canada in Ottawa, the $5. And while it's sitting in the business's bank accounts, well, guess what? It's a liability. So you've got an account called HST payable. Payable because that $13 you collected is not yours. It belongs to the government. In reality, you do actually get a little cut of it as a commission for being a tax collector, but we're just going to ignore that fact. So these flashing figures, this is the part that you also have to remember. The thing they have in common, this $100 going to the business and the $100 charged on the ticket price, that's the revenue. So whatever the ticket price is, that will always be the business's revenue. So remember that. Now, if the ticket price is always the revenue, that also means the tax collected is always the liability. But don't forget, a business can also be a customer of another business. So just to make the HST, it's actually the GST that's causing this problem, the federal government's portion, just to make it as complicated as humanly possible, when a business buys something it's going to use in the business to generate revenue, it actually gets the HST back. It has to pay it at the time, but it files paperwork, and all the HST it has paid, it gets back. So you also have to keep track of that, because it's very much like an accounts receivable. That if this business owner bought something for $100, it would eventually get the $13 back and only have had to eventually pay just the $100. So we also have an account to deal with that. It's called HST recoverable, and it functions very much like an accounts receivable, but it's not an asset account. More on that in a second. So before we move on, we have to learn about something called Contra Accounts, because you just had your second one. Yes, you already have one. One of our sales tax accounts is a Contra account, and it's HST recoverable. So a Contra account is an account that is basically associated with another or married to it. And they're called Contra because they act in the opposite way. In other words, a contrary way to the account they are married to and associated with. So what you do is you actually you combine the two of them, or compare them if you want to know what the total is, to come up with the final amount owing. So for example, when it comes to tax, you would take the HST payable and you would remove the HST recoverable to come up with the actual amount you have to send to the government. So with sales tax, your second Contra account is HST recoverable, and your first is actually drawings in the course. So let's take a look at some of them. There's more that you're going to get as we go through the course. The ones you need to pay attention to are the one that you know now are equity. Capital is your main account, and then the Contra capital account is drawings, right? Because it subtracts from capital to get sort of the net equity, ignoring revenue and expenses, right? So now under liabilities, you've got HST payable from the tax you have collected from customers that you owe the government, because it's a liability. And then you have HST recoverable, which is the tax that you as a business have paid on the things you've bought. You get that back. So the net amount, ignore this G, it should say HST now. So once upon a time it was GST, now it's HST for harmonized sales tax. So the actual amount you owe would be the 20 that you've collected from customers, and minus the $900 that you paid on the things you bought. So you only have to send the government a check for $19,100. That's how it works. Let's look at how we journalize these a little more carefully. So remember, the HST payable is the liability. You owe that because you collected from customers. The HST recoverable is what the government owes you. It's the tax you paid when you, as a business, bought stuff that you get back, because that's how the tax works. Okay? This is the most important screenshot. Remember it, because students start to get really confused from this point on in the course with some stuff, especially journal entries. This can be confusing. Remember it, because when you buy, you get the HST back. The HST recoverable is only going to ever appear with purchase-related transactions. Even if you return something you bought, you will be undoing the transaction and undoing HST recoverable. So HST recoverable appears with purchase-related transactions and only with purchase-related transactions, right? Because it's normally a debit, but when you do a return, you're crediting it, and you're going to assume that, hey, because I usually credit payables, payable here, and it's not true. So if it's purchase related, and that means buying it or returning a purchase. Likewise here, your payable tax account is only going to appear when you have revenue related transactions. So either original revenue, so sales, or a sale return. It's still revenue related. It will only use the payable tax account. Got it? Here we go. So all of these examples will assume we have a transaction for $1,000 cash. Got it? Let's focus just buying. So let's say we buy $1,000 of supplies with cash. So the cost of the supplies is $1,000, right? However, we're going to pay more than that, but the cost of the supplies is only $1,000 because we're going to get this HST back. This is the amount the government owes us. They're not paying us at the time we buy the supplies. We have to pay up front. We get the money back later when we file a whole bunch of paperwork, right? So if the cost for the merchant was $1,000, then we have to add 13% on that, which means the total that we actually spend and give to the business, to our supplier, is $1,130. $1,000 plus 13% more for tax. That's what a purchase looks like for a business. Okay? Because the HST is only paid by the final consumer. So businesses get it back. Likewise, when you are selling, or I guess not likewise, but opposite, when you sell, you will collect $1,130, right? The amount that we charge for our item or our service, plus the tax we are forced to collect from the customer because the government makes us. So we will collect $130 of tax, 13% of the $1,000. That's not ours. We take it along with our $1,000, right, in the $1,130, but it's not ours, so we owe it. So it's a liability. So we credit accounts HST payable, which is a current or short-term liability. We also credit the amount we charge, right? This is $1,000 because we said all of these transactions would be for $1,000 cash, right? So the ticket price was $1,000. The ticket price is always our revenue. So our revenue is $1,000. The tax we collect is $130 that we owe to the government. So that's a liability. And the total that I could put into our bank account because of this sale, this revenue transaction, was $1,130. What would it look like if we returned these supplies? Well, you'd have exactly the same accounts, except the debits would be credits and the credits would be debits. And as you can see, the HST payable is a credit. So when you would return these supplies, you would want to credit a tax account. And the instinct will be then, because it's credit, to use payable. That is not true when you are buying. So purchase related, including returning a purchase, you will use HST recoverable. Likewise, when you have a revenue related transaction, you will use HST payable, either to record the revenue, or if the customer returns something and you're giving a refund and you're returning the revenue or undoing the revenue, you're still going to use payable. You have to reverse the payable. You'll be debiting the payable, but you still use payable when you have a revenue-related transaction. Okay, so remitting the tax. Let's say our HST recoverable is greater than our payable. So the government owes us more than we owe the government. So in order, by debits first, it would look at something like this. And I should have done this in the order. I'm going to do it like this. So let's say our HST recoverable, this is what our government owes us, is $500 and our payable is $400. What we do is we clear out the balance in those accounts. Recoverable is a debit, so we credited $500 to get rid of it. I made all these numbers up, by the way. Made all these up. So we credited $500 to clear it out. Payable is a liability, so it had a credit balance. So we're going to debit it to clear it out to zero, right? So to zero it out, we debit that. So the difference determines how much money is either sent to the government or how much money the government owes us. In this case, the government owed us $500. We owed the government $400. So the difference is $100. They owe us $100. So we debit accounts receivable from the government for $100. When the opposite is true and the payable is larger, in this case I said the payable was $600, we do the same thing. We debit the payable to clear it out and credit the recoverable. Right? So here we said that HST recoverable was $400 and payable was $600. So we debit the liability account to zero it out. We credit the recoverable that is owed to us to clear it out. The difference is $200. and the payable is larger, so we owe more than the government owes us. And so we send a check to the government for the difference, $200. That's how it works. It's either going to be this one, this format, or this format, depending on which one's larger. And if you're selling stuff and making a profit, it's almost always this one, where you owe the government more than they owe you from your purchases. So let's try a couple more examples. So again, this time we've got a source document to go from. Okay, so we got two. So on June 1st, we got a source document. It is an invoice for services performed. That means it's a sales invoice. So we're a law firm or some kind of firm. We performed a service for a client. It's clear we're a law firm. So a will was drawn up for the estate of this person. So the amount charged, so the revenue for the firm was $9,700. We need to add HST under that. No cash changed hands yet. So this was an on-credit transaction. And these are things we don't need to worry about until we learn about discounts. But what it means is the client will get 3% off if they pay within 10 days. And they have a net total of 30 days to pay before they have penalty. So June 1st, let's just type June. So we got June 1st, and we will collect money. How much will we collect? Well, it's not going to be cash. It's going to be accounts receivable to start with. And this is almost always the tax account in the middle. Now, this is not a purchase. It's revenue. So it's got to be payable, whatever you're doing with it. And we're going to have some kind of fees earned. There it is. So our fees earned is what we charge, the ticket amount, right? Ticket price, I like to call it. So if you went into a store, saw something you liked, the price on the little ticket or the tag, right? That would be the revenue for the store. So $9,700 is what was charged. So $9,700 is a law firm's revenue. Always. That's the easy part. Also easy is the cash or the receivable. It's just the total of these two. Then you just take the amount, and you multiply it by 13%, which is $1,261. So on $9,700, you have to levy a sales tax of $1,261, and the customer owes you the total of both. And that's the entry. Let's try the next one. So on the second, we have a purchase invoice. So the business bought something. So it looks like they sent in some of their vehicles to have oil changes, and it's $560. No cash change hands again, so you're going to owe money to the auto shop, and you got to add tax on it. So it's going to be, in this case, it's going to be an expense, right? Some kind of repairs or vehicle or automobile expense. Here we go, automobile expense. And the expense is the amount charged, $560. We have to pay the tax, but remember, we're going to get it back. So on all purchase-related transactions, our HST account is the HST recoverable. And it's very much like an accounts receivable. We're going to get it back, so we debit it. So $560 times 13% means we paid $72.80 of tax. And we're going to get it back, so we debit it to that account. And the amount we have to give the business right now, although we're not, but we're going to shortly, so we have to use accounts payable. The amount we have to give them is what they charged us plus the tax they had to levy because the government says so. Simple as that. So give exercise 19 a try. It's got a couple of transactions you have to enter with sales taxes, and you're entering them from source documents. I know a fair bit all at once, but give it a crack, see how you do.